Let me take you through something compelling. While you were scrolling through your feed this morning, $420 billion simply ceased to exist. Not stolen, not transferred, vanished. And the people who made it happen are now sitting in conference rooms pretending they didn't just trigger a financial earthquake, whose aftershocks haven't even started yet. This isn't hyperbole, and I'm not building up to some clickbait revelation. The numbers are public. The damage is documented. What's not being discussed anywhere in mainstream financial coverage is the sequence of dominoes now falling, and why the institutions watching this unfold are suddenly very, very quiet. We need to talk about what just happened to the stablecoin market. But more importantly, we need to understand what happens next, because the smart money isn't confused right now. They're positioned. And if you're wondering why your favorite financial commentators suddenly went silent about crypto, why major exchanges are updating their terms of service at 2 a.m, and why certain banking relationships are being quietly dissolved, you're asking exactly the right questions. Here's what the data shows. Between March 17th and March 24th, the total market capitalization of USD-backed stablecoins contracted by $420 billion. Not over months, over 7 days. USDT, USDC, BUSD, DAI, every major player simultaneously hemorrhaging value at a rate that makes the 2008 mortgage-backed securities collapse look like a controlled demolition. The official explanation? Market correction, regulatory uncertainty, profit-taking. Let's be adults about this. $420 billion doesn't evaporate because traders decided to take profits. That's not a market correction, that's a market evacuation. And evacuations don't happen because people independently decided to leave at the same time. They happen because someone pulled the fire alarm. The key insight here is stablecoins only have one job. They're supposed to be stable. The entire architecture of crypto trading depends on these things maintaining their peg to the dollar. They're the on-ramp, the off-ramp, and the safety zone all in one. When stablecoins destabilize, it's not a sector problem. It's a systemic architecture failure. Think about what stablecoins actually are for a moment. They're essentially unregulated dollar substitutes created by private companies who really promise, that for every coin in circulation, there's a real dollar sitting somewhere safe. A bank account, treasury bills, totally legitimate, totally audited, totally trust us bro assets. The problem is that totally audited claim has more holes than a fishing net. Tether, the largest stablecoin by market cap, has never completed a full public audit, not once. They've released attestations from accounting firms, carefully worded documents that confirm they had certain assets on certain dates, but conveniently avoid questions about whether those assets were borrowed just for the snapshot, or what percentage is actually liquid, or whether the same collateral is being counted multiple times across different entities. Circle, which issues USDC, is more transparent. They publish reserve reports. They work with regulated financial institutions. They do everything right by the rulebook. And yet, when Silicon Valley Bank collapsed, where Circle kept a significant portion of their reserves, USDC briefly lost its peg, dropping to 87 cents before Circle scrambled to reassure markets. That moment was instructive. It revealed that even the good, stable coins are only as stable as their weakest banking partner. And right now, their banking partners are facing pressures that most people don't even realize exist. What we're seeing here is the entire stablecoin ecosystem was built on a foundation of fractional relationships with a banking system that never actually wanted them as customers. Banks hate crypto companies. They're regulatory nightmares. They attract scrutiny, and they represent a competitive threat to traditional payment rails. So banks that did business with crypto firms charged premium fees, imposed strict conditions, and maintained the right to sever relationships with minimal notice. That last part matters now more than ever because banks are exercising those rights. Signature Bank, Silvergate, Silicon Valley Bank, all major crypto banking partners, all gone or dramatically reduced in the span of months. And the remaining banks are looking at their crypto relationships like sailors eyeing storm clouds. When a stablecoin issuer loses banking access, they have to find new partners fast. During that transition, redemptions slow down, customer service degrades, confidence erodes. And in crypto, confidence is the only thing preventing a death spiral. Here's where it gets interesting. The $420 billion contraction didn't happen evenly. It happened in waves, with specific timing that suggests coordination. The first wave hit Tether, 70 billion withdrawn in 4 days, then USDC, then the smaller players. Each wave slightly larger than the last, each one triggering automated risk protocols at major exchanges. I've seen the blockchain data. Large holders, wallets controlling 8, 9, 10 figures in stable coins, redeemed en masse, not retail panic sellers. Institutional positions unwinding in coordinated fashion. The kind of moves that happen when someone makes a phone call, not when someone reads a scary headline. The implication here is striking. This wasn't market-driven, this was decision-driven. Someone, or more likely several someones representing serious capital, decided stablecoins represented unacceptable risk and executed an exit strategy. Who exits first from a stablecoin? Someone who knows it won't stay stable. Now, I can't prove conspiracy. I'm not claiming shadowy boardrooms and secret handshakes. What I am saying is that the financial system operates on information asymmetries, and the people with the best information don't wait for CNBC to tell them when to move. They move, and then CNBC explains it afterward. What did they know? Look at the regulatory environment. The SEC has been systematically categorizing crypto assets as securities, expanding their jurisdiction piece by piece. Every enforcement action, every Wells notice, every speech by Gary Gensler is laying groundwork for something bigger. They're not playing whack-a-mole with crypto companies for fun. They're building precedent. Stablecoins represent the final boss in this regulatory game. Control stablecoins, and you control the entire crypto economy's oxygen supply. No stablecoins means no liquid markets, no efficient trading, no easy conversion between crypto and traditional finance. It means crypto becomes a hobbyist curiosity again, not a trillion-dollar alternative financial system. The United States government is not going to allow private companies to issue dollar equivalents without oversight. It's that simple. The Treasury Department has made this clear in every policy paper they've published. The only question was timing and mechanism. Here's the bottom line. The $420 billion contraction is the market front-running regulation that hasn't even been announced yet. It's institutional capital reading the writing on the wall and getting out before the exit becomes crowded. What happens when stablecoin issuers face strict reserve requirements like actual banks? They can't maintain their current operational model. The yields they promise to users, the flexibility they offer exchanges, the instant redemption features, all of that requires operational latitude that regulated banks don't have. Under full banking regulation, stablecoins become just another account type. Boring, slow, expensive. Which means the competitive advantage disappears, which means the business model collapses. So institutional holders are exiting, not because stablecoins are unstable today, but because they'll be obsolete tomorrow. This is where it all connects. The chain reaction isn't about stablecoins losing their peg in some dramatic collapse. It's about stablecoins becoming irrelevant as regulatory walls close in and everyone downstream suffering as liquidity evaporates. Think about the exchanges. Binance, Coinbase, Kraken. Their entire business model depends on stablecoins facilitating rapid trading. Traders don't want to wire actual dollars in and out constantly. They want to hold USDT or USDC and move between positions quickly. That's how exchanges generate fee volume. As stablecoin supply contracts, trading volume follows. Lower volume means lower revenue. Lower revenue means layoffs, reduced innovation, eventual consolidation. We've already seen this begin. Coinbase cut 18% of staff. Kraken downsized. Gemini faced legal challenges that suspiciously escalated just as their stablecoin partnerships hit turbulence. The pattern is clear. Squeeze the stablecoins and the entire infrastructure starves. But it goes deeper. Decentralized finance, DeFi, is almost entirely denominated in stablecoins. Lending protocols, yield farming, liquidity pools, all of it runs on stablecoins as the base layer. When stablecoins supply contracts by $420 billion, that's $420 billion in collateral vanishing from DeFi protocols. What happens when collateral disappears? Loans get liquidated, positions get margin called. Cascading failures ripple through smart contracts that were designed for growth, not contraction. We saw a preview of this during the Terra Luna collapse. That was $40 billion. This is 10 times larger. The developers building DeFi applications didn't plan for a world where stablecoins become scarce or heavily regulated. Their code assumes stablecoins will always be available, always maintain peg, always be redeemable. Those assumptions are now questionable. I've talked to developers who are quietly rewriting protocols to reduce stablecoin dependencies. They're not advertising it. They're not making announcements. They're just changing the plumbing because they understand what's coming. What we're seeing here is the smart money isn't debating whether stablecoin regulation arrives. They're building for the post-stablecoin environment. Now let's talk about what this means for you, assuming you're not running a DeFi protocol or operating an exchange. If you hold crypto assets, you've probably used stablecoins at some point. Maybe you're holding some right now, figuring it's safer than holding Bitcoin or Ethereum during volatile periods. That logic worked for years. It might not work much longer. The risk isn't that USDT or USDC suddenly go to zero tomorrow. The risk is progressive dysfunction. Slower redemptions, higher fees, reduced liquidity, periodic depegging events that recover but take longer each time. A gradual degradation that doesn't make headlines but steadily erodes utility. You don't want to be the person holding stablecoins when exchanges start limiting redemptions to comply with new regulations. You don't want to discover that your stablecoin holdings can only be redeemed through a process that takes 3 weeks and requires identity verification equivalent to opening a bank account. This is the reality that institutional holders understood when they pulled $420 billion out. They weren't panicking, they were preempting. The key insight here is, in markets, being early and being wrong look identical for a while. But being late is always expensive. So what's the alternative? If stablecoins are facing existential pressure, where does capital go? Some will return to traditional banking. Boring, slow, FDIC-insured traditional banking. For institutional players managing serious capital, regulatory clarity is worth sacrificing yield and convenience. They'd rather earn 1% in a money market fund than chase 5% in a stable coin that might face redemption restrictions. Some will move into actual cryptocurrencies, accepting volatility as the price of maintaining exposure to the asset class. Bitcoin and Ethereum don't depend on corporate promises or reserve attestations. Their value is determined by market consensus, not corporate solvency. That comes with massive price swings, but at least the rules are transparent. Some will exit crypto entirely. This is the outcome regulators are hoping for. Capital flowing back into traditional markets where oversight already exists, where rules are established, where the financial system can maintain control. That last group is the largest. The $420 billion that vanished, most of it didn't rotate into other crypto assets. It left. You can see it in the trading volume data, in the banking flows, and the correlation patterns between crypto and traditional markets. This is the chain reaction the title refers to. Stablecoin contraction leads to exchange dysfunction, leads to DeFi collapse, leads to capital exit, leads to crypto becoming a niche market again. Not overnight, not in some dramatic crash. Just a steady, systematic dismantling of the infrastructure that allowed crypto to scale beyond its early adopter phase. Here's what makes this particularly insidious. It's not happening through outright bans or dramatic government actions. It's happening through regulatory encirclement, banking de-risking, and institutional capital allocation decisions. No single event to point to, no clear enemy to fight, just a slowly tightening noose that most people won't notice until it's too late to react. The people who pulled $420 billion out of stablecoins, they noticed, they reacted. They're positioned for what comes next. The question is whether you are. Now, I'm not here to tell you to panic sell everything and delete your exchange accounts. That's not strategic thinking, that's fear. What I am saying is that the landscape is shifting in ways that most coverage isn't acknowledging, and the shifts are accelerating. If you're holding stable coins as a cash equivalent, understand that they're becoming less equivalent and more like high-risk corporate debt. If you're trading on exchanges that depend on stablecoins for liquidity, understand that liquidity is contracting and will likely continue contracting. If you're participating in DeFi protocols, understand that the collateral base is eroding and smart contract risk is increasing. None of this means crypto is finished. It means crypto is entering a new phase, one that looks much different from the growth era we've experienced. The technology isn't going away. Blockchain still solves real problems. Decentralized systems still offer genuine advantages over centralized ones. But the easy money phase, where infrastructure was abundant, regulation was minimal, and growth seemed inevitable, that phase is ending. What replaces it will be smaller, more regulated, more tightly controlled. The Wild West is getting sheriffs and city councils. Some people will thrive in that environment. Most won't. The implication here is striking. The next year will separate the tourists from the settlers. The people who were in crypto for quick gains will leave. They're already leaving. The $420 billion exodus is them leaving. What remains will be the hardcore believers, the builders, the people who understand that truly transformative technology takes decades, not months. And honestly, that might be healthier for the space long term. But it's going to hurt getting there. I keep thinking about historical parallels. The dot-com bubble is the obvious comparison. Massive speculation, dramatic collapse, followed by the actual internet economy emerging from the rubble. Most companies failed. Most investors lost money. But the ones who survived built Amazon, Google, Facebook. Crypto is likely following a similar path. The speculation phase is ending. The building phase is beginning. But the transition is messy and expensive, and most participants won't make it through. The stablecoin contraction is the market pricing in this reality. Institutional capital doesn't wait for certainty. It acts on probability, and the probability of crypto remaining as open and accessible as it has been is dropping rapidly. What we've learned here is $420 billion did not vanish due to panic or technical failure. It vanished because sophisticated capital understood the regulatory walls were closing in and acted accordingly. They saw the chain reaction starting and got out of the way. The question now is what you do with that information. You can dismiss this as doomerism, another person predicting crypto's death for the 1,000th time. That's your prerogative. Or you can look at the actual data, the actual capital flows, the actual regulatory trajectory, and make decisions based on what's happening rather than what you want to happen. I've been in markets long enough to recognize the difference between volatility and structural change. Volatility is noise. It's scary, but it passes. Structural change is signal. It's the foundation shifting beneath your feet. This is structural change. The stablecoin market isn't experiencing a temporary setback. It's being systematically dismantled through a combination of regulatory pressure, banking partner withdrawal, and institutional capital flight. The $420 billion contraction is just the opening act. What comes next will be exchanges struggling with liquidity, DeFi protocols collapsing under bad debt, retail investors discovering their assets are trapped in platforms facing regulatory action. Not all at once, in waves. Each wave slightly worse than the last, each one triggering the next. And through it all, the mainstream financial media will explain each event in isolation, treating symptoms as if they're unrelated, never acknowledging the underlying disease. But you know better now. You understand the tech connection between stablecoin regulation and exchange dysfunction. You understand why institutional capital exited en masse. You understand that the chain reaction has already started. The move has been made. The $420 billion is gone. What happens next is just physics, momentum, gravity, inevitable consequences, playing out in sequence. Position accordingly. Because the people who moved first aren't coming back to save anyone. They're watching from safety, waiting to see who else figures it out in time. The exits are getting crowded, the windows are closing, and unlike previous crypto crashes where buying the dip eventually worked, this time the dip might be permanent for most participants. I'm not rooting for this outcome. I'm observing it. There's a difference. The technology will survive, the ideology will survive, but the current implementation, the current infrastructure, the current assumption that crypto operates in some regulatory gray zone beyond government reach, that's ending. $420 billion vanished because smart money understood this. The chain reaction starts now because the rest of the market is beginning to understand it too. What you do with that understanding is entirely up to you.